गाइस, आप सब लोगों का स्वागत है आपके अपने चैनल यूट्यूब चैनल फिन पांडा। आज मैं आपके लिए एक और वीडियो लेके आया हूँ विच इज़ रिलेटेड टू अकाउंट्स, दैट इज़ IFRS 115, where I will not be going in too much detail, but we will discuss each and every point, grasp the entire concept of the standard. So without wasting too much time, let's get to the point. So first understand why we need this IFRS. So this IFRS is required for every entity, every organization, and every kind of enterprise, whether it's a firm, whether it's a proprietary firm, or whether it's a partnership firm, or maybe it's a business entity. Every entity is selling something or giving either the goods or services to the customer, and they derive some sort of consideration from them. So we have to recognize that, consider in the our books of accounts. For this purpose, we need some sort of mechanical process, that if we do not have a standardized approach, and it would make a lot of chaos. So that's why there's a body called IASB, which writes the standards on accounting, that is called IFRS, that is usually applicable onto the European side of the country. Okay, so now let's discuss what is the process that is defined by IFRS to recognize the revenue. There's a 5 points that we have to consider here, and we have to fill those 5 points to reach at the stage to recognize the revenue. Now let's discuss these 5 points one by one. That is, first step is that identify the contract with the customer. What is this step? In this step, the customer and the entity comes into the agreement, where they decide that what are the goods or service would be delivered over the period of time, or in the point of time, and what would be the payment terms, and there would be signing parties to the agreement, who are pretty much will be the parties to the contract. So now we have to understand what is this contract. Contract is simply an agreement which is enforceable by the law. So it means that two parties come into a mutual consent, whether it's written or orally, where they decide the terms and condition of a particular subject matter, whether it's about delivery of the service or goods, and they also lay out the payment terms. They also lay out what we call the conditions when the performance obligation would be satisfied for the entity to recognize the revenue, and those parties would also sign the contract. So this is what happens in this first phase, that is identify the contract with the customer. Second phase, what we call, is that identify the performance obligations. What happens in this stage? We simply identify what are the distinct performance obligation an entity have when they entered into a contract. So let's give you an example. Let's focus on this one. Okay, so what happens? A network company, that's Reliance or Airtel, any company that gives you service of like 2 years of network service in the rupees of 10,000. Okay, and along with, they are also provide you one handset to give, like a mobile phone. Okay, you can consider mobile phone free of cost. So in such a situation, we have to identify what is the obligation. Okay, so there are two obligation. One obligation is a handset, okay, for entity to provide you. Second one is the services for the 2 years. Okay, and they're charging entirely 10,000 rupees for that one. Okay, so now we know our two obligation. Now we will discuss when these obligation would be satisfied. Okay, so in standard, these are classified in two ways. One is that is a point in time sale, and second one is over the period of time. So in the point of time sale, what happens? Let's I sold one car to you. Okay, I transfer the control rights and obligation attached to that property. You give me a consideration, you are done with that. Okay, so this is called point in sale. You can recognize as soon as you transfer the control goods and services to the particular party, and all the rights and obligation okay, so let's first decide what is the control. So control is simply like ability to use, a right to use or direct the use of particular assets transferred to the customer is known as control, along with the rights and obligation, benefits and demands of which are attached to that particular assets are transferred to known as the control transfer. So this is one of the significant condition that has to be completed before recognize the revenue. Okay, so now we have discussed about the control, we have discussed about the performance obligation. As I said, these are two performance obligation. One is about what we call 2 year of service, one is a handset that you sold in front, I can say upfront, this two. Just what happens now, in 10,000 you have sold this one, so we have identified two performance obligation. In one we will recognize the revenue immediately, in the other one we will recognize the revenue over the period of time as soon as the service has occurred, or you can say the performance obligation is being satisfied. Okay, now let's talk about the third point, that is called determine or ascertaining the transaction price. Now we have to decide what is the transaction price. Here I have given you example. So in example, the 10,000 rupees is exactly a transaction price. This is what we have charged for the goods and service which we are delivering to customer. All right, now we are just considering 10,000 as our transaction price. Okay, so whatever we receive in exchange of the goods and services from customer is considered as a what we call transaction price. But we have to figure out one more point in there, that if the transaction price or the price that we are receiving from customer is affected due to the concept of time value of money. Let's say the normal terms of my business is to giving a 30 or maybe 3 months credit to the customers, but at the same time if I'm giving a customer to the credit of, let's say, 1 year, and I'm saying that I'm gonna charge 11,000 rather than 10,000 for this particular service that I'm giving a distinct person, I'm charging 10,000. But if I'm giving to that person, then I'm charging 11,000, but I'm giving him more 6 months credit. It means the 6 month credit and the 1,000 I'm charging extra. This is considered as a finance cost. Rather than recognizing it as a revenue, we will recognize it as a finance cost or not, or finance income in our books of accounts. Okay, so this one is also the concept that would come into the picture, but usually this thing, when we recognize what happens exactly, before applying time value of money, we have to also consider one more point. What is this? Whether the term of contract is consideration receiving is going more than 12 months, because if going more than 12 months, then is only we are applying this time value of money. Otherwise we always know that present value factor is 1. So for the 1 year we always consider it as without considering any time value of concept in here, to calculate the finance cost also. Okay, now the fourth point is the transaction price that we have determined earlier have to allocate this transaction price to the different performance obligations. Now we have a two performance obligation, as I told you. One is a mobile set and second is that the services of the 2 years. So now we have a 10,000 rupees. Okay, so how we will just bifurcate this transaction price into the purchase performance obligation. So let's say the similar handset phone is getting sold in the market, or by even the entity to the distinct customer in the rupees of 2,000. Okay, now what we have to consider, we have to club the price, that is called 2,000 plus 10,000, that is 12,000. Now we have to bifurcate this 12,000 into the ratio of 2,000 and 10,000. Whatever the ratio comes up, we have to multiply that ratio to the particular 10,000. Okay, so whatever the value comes, that is attached to the performance obligation, and that is the value we will recognize. So whatever the value comes, okay, we will recognize for the mobile handset, like what the value would be coming, it's like 2,000 divided by 12,000 multiplied by 10,000. Okay, so now calculate some of the figures in here to discuss further on. Okay, so now we have 2000 divided by 12,000, that is coming as 16.67%. We have to multiply this value to the 10,000. Now your mobile handset value is 1667, that is 1667 rupees. You have to recognize upfront as soon as you deliver the goods to the customer. Okay, now we subtract out this value 10 from 10,000. We have like 8,330 3. That value have to recognize in the period of 2 years. So what I call, we have to recognize this value in the 2 years, that is 4,166 rupees each year. So each year you have to recognize this value, and each year and you have to recognize this value and pass the entry for the revenue recognitions. So if you see that for the value of 10,000, that is the total transaction price, we have bifurcated into the performance obligation in the ratio of what would be the price if these services would have been um, given in distinct to the distinct customer. Okay, so we have done that way. So now we have attached the prices to the performance obligation. Now the other fifth stage is just to recognize the revenue. Now this concept kicks in when you figure out the values, but the thing is, what is important in here is that timing of recognize the revenue. You cannot recognize the revenue until unless the performance obligation is getting satisfied. Okay, so when the performance obligation is satisfied, I have told you in the second step itself that the performance obligation which is related to point in time, that's delivery of goods, and you are done with that. That's kind of selling a car, that's you deliver the goods to the owner, and rights and obligation are being transferred to him. Now as soon as you receive the consideration, you can recognize the value. Okay, now in the second point, that is over the period of time that we have discussed recently, that 2 years of tenure, then in such a case we have to recognize revenue after the 1 year, because the 1 year of service period is getting ended, and you can recognize that value of 400,167. All right, this is how in the second year you will recognize the same value. Okay, so this is the entire concept of revenue recognition in terms of 5-step process. I believe for further discussion on this topic, we can discuss in a different or maybe in next videos, where I will telling you the type of transaction in the IFRS defines, like refinancing transactions and financial arrangements, where you have to recognize it as a lease rather than as a revenue. All right, on some of the cases you can recognize as a financial arrangement instead of revenue, because the nature of transaction defines whether it's going to be covered as a nature of revenue or other type of transaction. When we have sale the goods on consignment, when we have sale with the provision of the refund of goods. So there are different enormous, or you can say a number of type of transactions are defined by the IFRS. We have to discuss each one by one. There's a pros and cons of each topics which we'll be discussing later on. And there's some of the topics are pretty much complex, some of are very much easy. It's easy to understand, you don't need to put so much effort on them to understand. Okay, so all right, if you really like my video earlier that I posted today's video, then please like, subscribe and share the video. And I really require your love and support to just enhance my capabilities, and to enhance the knowledge of the people who really wants to get aware about the different concept and the science behind these concepts. All right, thank you very much for watching this video, and don't forget to subscribe, like and share my video. Thank you guys, bye.